What is automatic withdrawal fidelity? Automatic withdrawal at Fidelity enables customers to regularly withdraw a set amount from their investment or retirement accounts, an option that has significant implications for retirees and investors who rely on steady income. Recent data from the IRS shows that 71% of retirees are concerned about managing systematic withdrawals to avoid depleting their assets too quickly. Fidelity's automated approach aims to streamline withdrawals and ease the anxiety of managing finances in retirement. Fidelity's automatic withdrawal feature offers flexibility and convenience for investors, allowing them to schedule recurring withdrawals from accounts like IRAs or taxable investment accounts. This function is especially valuable for retirees who need regular income to cover expenses or meet required minimum distributions (RMDs) after age 73, as mandated by U.S. tax law. Additionally, users can customize the timing of withdrawals, choosing monthly, quarterly, or annual options based on their needs. Investors can also set specific dollar amounts or percentages to align withdrawals with budgetary or inflation adjustments, which can be key to preserving financial health over time. Despite these advantages, automatic withdrawals carry risks. Withdrawals may incur tax implications depending on the type of account. For instance, traditional IRAs are subject to federal income tax, and there's a 10% early withdrawal penalty for those under 59.5, unless qualifying exceptions are met. This tax burden can be significant if the withdrawals unintentionally push the account holder into a higher tax bracket. For Roth IRAs, withdrawals can be more advantageous since they are generally tax-free after 5 years, but early withdrawals on earnings may still trigger penalties. Fidelity users should carefully consider their tax situation and perhaps consult with a financial advisor to minimize these risks and make tax-efficient decisions. One of the downsides users report is the lack of flexibility in the investments eligible for automatic withdrawals. For instance, Fidelity allows these withdrawals primarily from its mutual funds and money market accounts rather than individual stocks, bonds, or ETFs. This limitation may restrict some investors from maximizing their preferred asset allocations. Furthermore, there are concerns about the potential to deplete assets prematurely if the withdrawal rate is set too high, especially during market downturns. While Fidelity provides tools to assist users in calculating sustainable withdrawal rates, there remains a need for careful monitoring. This can be daunting for users unfamiliar with rebalancing or adjusting withdrawal rates, which is essential to avoid over-withdrawing and running out of funds early. However, the convenience and structure of automatic withdrawals can provide peace of mind for retirees or individuals seeking passive income. This feature is particularly suited to users who prefer a set-it-and-forget-it approach to managing their finances. It offers the ability to automate financial processes, ensuring timely access to funds and reducing the stress of manual financial management. Importantly, Fidelity allows users to modify or stop automatic withdrawals at any time, making it a flexible solution even when personal or financial situations change. Automatic withdrawals at Fidelity can significantly simplify financial management and provide steady income, but users should be aware of the limitations and potential tax implications. Fidelity's automated withdrawal service is a helpful tool for those looking for structured, regular payments, but successful use requires awareness of the potential financial and tax impacts to ensure it meets the user's long-term goals effectively.